For decades, silver has been treated as a solved equation, a commodity whose price supposedly reflects a balance between mining supply, industrial demand, and investor interest. Yet within institutional models, there's a growing discomfort that the math behind that balance no longer reconciles cleanly, and that quiet unease is starting to surface in places it normally wouldn't. At the analytical level, what looks like a modestly sized market on price charts begins to expand dramatically when measured against how much silver is referenced, promised, or implied across contracts, inventories, and financial products. And the gap between what appears to exist and what is effectively spoken for raises a question that no single data set can fully answer. In risk committees and trading desks, the concern isn't framed as a shortage or a squeeze, but as a valuation mismatch, where even conservative assumptions can produce notional figures that feel uncomfortably large relative to the size of the physical market that's supposed to anchor them. What complicates the picture is that silver isn't just an investment metal, it's embedded in manufacturing, energy systems, and supply chains that don't respond to price signals the way financial models expect, and that structural rigidity makes the arithmetic less flexible than spreadsheets imply. Behind the calm surface of daily pricing, there's a sense that silver's market structure may be carrying more implied value than it can smoothly settle if stress appears, and whether that imbalance is theoretical or actionable is the question that hasn't been resolved yet. On paper, the silver market looks orderly, with prices updating smoothly and volumes appearing manageable. But beneath that surface, the market is stitched together by layers of claims that don't behave like physical metal when conditions tighten. At the structural level, silver is priced at the margin, not by the bulk of what exists, but by relatively small volumes changing hands, and that mechanism works only as long as confidence holds that any larger obligations would never need to be tested all at once. In institutional modeling, silver is often treated as infinitely nettable, where paper obligations cancel each other out cleanly, yet that assumption depends on timing, liquidity, and counterparties acting predictably under pressure, which history suggests is far from guaranteed. What unsettles analysts is that a single ounce of silver can be referenced simultaneously in multiple contexts: inventory reports, leasing arrangements, derivative hedges, each legitimate in isolation, but collectively difficult to reconcile if delivery or withdrawal behavior changes suddenly. The market functions because most participants don't ask for the same thing at the same time, and the moment that assumption is questioned, even quietly, the math supporting today's valuations starts to look less stable than it appears. What keeps this structure intact is behavioral consistency, not physical abundance, and silver's market has been conditioned for decades to expect rollover, cash settlement, and substitution, rather than confrontation with the underlying metal. In internal discussions, the phrase that comes up isn't default, but concentration, because a surprisingly small number of nodes, vaults, clearing members, custodians, sit at the center of flows that look diversified only when viewed from a distance. When analysts attempt to map these flows, the numbers don't necessarily contradict official data, but they begin to stack on top of each other in ways that inflate exposure without triggering alarms, creating a kind of invisible leverage that doesn't show up on balance sheets. This is where the larger figure starts to emerge, not as a headline number, but as an implied outcome where the cumulative value of promises tied to silver can expand far beyond what would ever trade physically at prevailing prices. The uncomfortable implication is that the market's stability relies less on metal and more on shared expectations about behavior, and expectations, unlike ounces, can shift quickly when stress tests stop being theoretical. At this stage, the discussion moves away from supply statistics and toward settlement mechanics, because that's where abstract exposure meets real-world constraints, and silver's settlement pathways are narrower than most participants assume. In calm conditions, offsets and netting smooth everything out, allowing large positions to exist without ever demanding movement of metal. But those same mechanisms depend on uninterrupted liquidity and trust between counterparties that may not share the same incentives in a volatile environment. Market behavior suggests that silver is increasingly used as a balance sheet tool rather than a delivery asset, which works efficiently until the purpose of holding the position changes and the option of taking metal, however remote, begins to matter. What makes this more fragile is that industrial users and financial holders operate on different timelines, and if even a small subset of participants shifts from rolling exposure to securing supply, the stress doesn't distribute evenly across the system. The math doesn't break immediately, but it tightens, forcing choices that haven't been required in years, and once those choices surface, the true scale of implied exposure becomes harder to dismiss. As pressure builds, attention turns to pricing itself, because price is the signal that's supposed to balance all of this, yet silver's price discovery is heavily influenced by financial flows that can expand or contract far faster than physical availability. In institutional reviews, there's a recognition that price can stay low, not because supply is ample, but because the marginal trade is satisfied with paper exposure. And that distinction matters only when the market's preferred form of settlement changes. Available data suggests that even modest reallocations from synthetic exposure toward physical custody can absorb volumes that look trivial in dollar terms, but significant relative to what's readily accessible. And that asymmetry doesn't show up until it's already in motion. This creates a paradox where a market can appear liquid, deep, and stable, right up to the point where it isn't, because the liquidity was never designed to handle physical preference at scale. What worries risk managers isn't a dramatic price spike, but a quiet repricing of assumptions, where silver's role shifts subtly and the math that once felt conservative starts to feel incomplete. When the conversation reaches this point, it inevitably widens beyond silver itself, because the metal sits at the intersection of finance, manufacturing, and policy, and stress in one area doesn't stay isolated. From a geopolitical perspective, silver's industrial importance means supply chains are increasingly strategic rather than purely commercial, and that introduces actors whose priorities aren't driven by price efficiency or short-term returns. Market behavior implies that these participants are less tolerant of substitution and delays, and if their demand intersects with a financial market accustomed to flexibility, the adjustment process becomes uneven and difficult to model. What's rarely discussed openly is how quickly confidence-based systems can reprice when a small number of participants act differently than expected, not in panic, but in preparation. At that point, the question stops being whether silver is scarce and becomes whether the system built around it can adapt without forcing a reassessment of value that feels sudden only because it was deferred. By the time this reaches senior oversight, the framing changes again, because what's being evaluated isn't silver's price, but silver's reliability as a reference point within larger portfolios and hedging structures. In these assessments, silver begins to look less like a passive input and more like a potential amplifier, where small disruptions can cascade through positions that were never intended to interact directly with the physical market. What unsettles decision makers is that this exposure isn't concentrated in one strategy or sector, but diffused across products that assume normal settlement behavior as a baseline, not a variable. The resulting risk isn't explosive, it's accumulative, building quietly as more obligations lean on the same underlying assumptions. And the longer that continues, the harder it becomes to unwind without revealing scale. At that stage, the math isn't questioned because it's wrong, but because it may be incomplete, and incompleteness only becomes visible when the margin for error starts to narrow. At the edge of this analysis, the discussion returns to first principles, not to predict a break, but to acknowledge how fragile coherence can be when a market grows through layers rather than depth. Silver's pricing framework assumes continuity, that tomorrow will resemble today closely enough for adjustments to remain incremental. Yet continuity depends on behaviors that aren't contractual and can't be enforced once incentives shift. What makes the implied figure feel unsettling isn't its size in isolation, but the realization that it emerges naturally from standard practices, not from excess or speculation, and that means unwinding it would require coordination, not correction. In that context, the question of a multi-trillion-dollar imbalance isn't about exposure that will surface tomorrow, but about whether the system has quietly accepted a level of abstraction that exceeds its physical anchor. And when abstraction drifts too far from constraint, the repricing that follows rarely announces itself loudly. It arrives as a recalibration that feels overdue only after it's already begun. What brings this into focus isn't a single trigger or revelation, but the cumulative recognition that silver's market has evolved in ways its original assumptions never fully accounted for. The numbers that appear startling aren't projections of loss or gain. They're reflections of how many layers of reliance have formed around a relatively small physical base, each reasonable on its own, yet collectively difficult to reconcile under stress. In that light, the question isn't whether silver is mispriced today, but whether its price still performs the function the system expects of it, and whether that function can hold as participation broadens and motivations diverge. Markets don't fail because their math is incorrect. They fail when their math no longer maps cleanly onto behavior, and silver's market is now testing that boundary quietly, without drama or warning. If there is a reckoning, it won't arrive as a shock, but as a shift in how value is referenced, settled, and trusted. And by the time that shift is obvious, the problem will already have stopped being theoretical. Markets don't fail because their math is incorrect. They fail when their math no longer maps cleanly onto behavior, and silver's market is now testing that boundary quietly, without drama or warning. If there is a reckoning, it won't arrive as a shock, but as a shift in how value is referenced, settled, and trusted. And by the time that shift is obvious, the problem will already have stopped being theoretical.